It's nice, huh? Okay. Okay, let's start then. Thank you very much for being here today. I'm Giuseppe Basile. I'll be your host for this workshop. I'm a contributor to fxtrade.com, and you might know fxtrade.com is the largest portal in the world focusing on Forex. And today I'm going to present a new philosophy for trading success in modern markets. Why I use modern markets is because current markets are way different from the markets that we think we know. And actually the market that actually generated all those concepts are very common in technical analysis. So now before I start, if you want to share pictures or comments or anything, please do, and you can use the hashtag FSTradeEvent as well. That would be very appreciated. Now, before I get into the meat, let me just share with you 3 minutes about the FSTrade portal. When you navigate to fxtrade.com, you see this main page. There's a main menu there, and there are different sections. When you pick the section, you actually have a sub-menu there. And in this case, when you click on rates and charts, you can find a few menus, items related to currency, rates, charts, and different type of charts, not only focusing on Forex, but also on related markets. And there are different ways you can do different features you can use. Actually, you can have news on charts, and you can have multiple charts, organize them in workspaces as well as sharing them. And now, you know, a lot of people, of course, and I would say, of course, starting traders, they might not have a platform, so that's a very handy solution. And also when you are on the go, you can use this to connect with an internet connection. You can check your charts. It's quite handy. Of course, news is a very important part. There are technical Forex news, and there are also fundamental news. An important part of the website is dedicated to analysis, and you will see that you can actually pick and choose and filter the analysis based on the Forex pair you are interested most in. And there are other tools as well, like trading position. I like that a lot. Every now and then I post my own position there. I'm a contributor to fxtrade.com. And there are also forecasts that come from experienced traders, from big institutions, as well as from the average Joe who actually has a very good track record. So there are some tools as well. What is interesting is that you can organize your own tool. There are 43 different type of widgets, and you can do all this online. You just click on Add Widget, and it's a very hand tool if you don't want to spend money also in a platform. So it's quite, I think it's quite useful. And of course, there are webinars and educational content. There are great speaker there, and there is also the live analysis, which is an initiative started last year by fxtrade.com. That's a large trading room. Every day 400 people meet in the room. There is this gentleman, Dale Pinkert, who's actually the host of this trading room. So that was a very brief introduction. I maintained my promise. So let me talk to you about a little bit what we need, a new philosophy when it comes to trading success in modern markets. I'll give you 3 reasons. The first one is that despite the amount of information that we have nowadays accessible when it comes to studying the market, and especially in the last 10 to 15 years, and also the access that we have to the market. It's so easy to open an account and fund it. You can even fund it with a credit card these days. So you can be up to speed in 5 minutes. You have a lot of information about trading, but yet the number of retail traders who are successful oscillates between 92% and 95%. Sorry, they are not successful. So we're speaking about 95% of retail traders who consistently lose money in the market. So reason number one why we need a new philosophy, and actually there is something fundamentally wrong in the way we learn trading. The second reason is that the market have changed radically. Now, I'm going to show you what I mean here. Program trading is overwhelming. Algorithms are overwhelming. And there are different classes of algorithms. When we speak about algorithms, a lot of people normally think about HFT, high-frequency trading. But there are several family and groups of algorithms in the market. I'm going to show you, I'm going to focus on one of them, which is very, very interesting because we can actually create an edge out of it. The third reason is that I believe there is a fundamental mistake in using technical analysis these days, and that shows in the results, of course. When 95% of people lose money, it means that something is fundamentally wrong. And particularly, people do not understand that the validity of technical analysis comes only as a tool to generate tables of statistical historical data on the market. Technical analysis doesn't tell anything about the reality of the market. And the reality of the market these days is totally different. So, of course, risk is very important. Trading is not for everyone. And I think it's important to realize that, and you know that very well, when the money is gone, the game is over. So a lot of people I talk to, I'm a mentor myself, I speak to a lot of people, and normally a lot of traders lose between $2,000 and $6,000 in the first 3 to 6 months. That's the typical average. So you don't want to do this mistake. And risk management is paramount, of course. So a little bit about myself, just 2 minutes. I'm a computer science engineer, but then in 2005 I decided that I wanted to get my future with trading. And I started in 2001 really. In 2003 I really committed on research. And only in 2006 I understood that without mentoring I wouldn't go anywhere. And so I looked for the best people. Van Tarp, I studied with him. Very important for market psychology as well as risk management and money management techniques. Huge. Ivica Jurasic stocks, D.R. Barton stocks techniques, David Asley algorithms, and Joe DiNapoli, I think everybody knows him, did a big work on Fibonacci as well as, I think Joe DiNapoli is one of the traders who has the best understanding of price structure at the moment. So before I continue, just telling you 17 hours exposure to market, 8,000 hours only in the last 4 years. And I started a blog to talk about my techniques, and recently I also launched a mentoring program. It's going very well, and I'm going to continue. I'm very satisfied about it. What's my trading edge? How I do things differently? Well, spotting algorithms, footprints on price. Footprints means spotting those areas and those levels where participation from certain class of algorithms is anticipated. So why we need a new philosophy? I mean, I already spoke about this. We want to do things differently, and we have to if we want to produce different results. Otherwise, the results we produce are the average results, 95% of people losing money. That's the reality of market. And I like to say in a little bit bluntly, I like to say we are all statistically losers. So if we don't do something differently, that's where we end up. Okay? Now, there is an opportunity, which is the presence of algorithmic trading, and I'm not going to stop at words. I'm going to show you what I mean with that in the next slides. I only use proven, grounded price behaviors. There are only a bunch of price behaviors that can be proven formally, and I'll show you those. Now, a lot of people invoke self-fulfilling prophecies like bounces from notable moving average and this kind of behavior, or putting together multiple technical analysis signals to kind of try to generate something that is much more important and stronger in terms of the impact that it can have on price. But I'm going to show you that this is a flawed concept. I'm going to show you in one example, but I can show you this on multiple examples. And you give me the trading tool, the traditional technical trading tool, and I'm going to show you a chart that negates the fact that self-fulfilling prophecies can be useful. By the way, self-fulfilling prophecies are called by the institutional traders the sitting duck levels. I mean, that's where they're going to source for their volume, okay, to execute their trade. So I avoid, of course, reconciliation of multiple signals. A lot of people are very happy of putting things together. And maybe they even generate or think they can generate stronger signals from weak indications. Think about Fibonacci confluence, a typical concept in which a Fibonacci number is a weak support of resistance. And there is no way that when you combine two of them from two different Fibonacci traces, if you understand what I mean, you get something that is much stronger. So I don't rely on planned news. Actually, I have a strong belief news are used by algorithms and professional traders to push their positions into targets. And I saw this again and again and again in the last 6 years. I also think it's important to follow some key rules, and simple rules, but very often they're not accepted. Let me mention one. Protect precious capital. That would be the rule number one. And a lot of people that don't even know how much they're risking. Actually, recent data from Oenda, which is a large North American broker, says that 22% of retail traders never put a hard stop. And the majority of them end up losing all the capital by receiving a margin call. And that's not good for anybody. It's not good for traders. It's not good for brokers either. It's not good for anybody. But especially I gather, and I'm interested in what traders do. Trading is also about setting up a process for correct decision making, and we say in the business that as traders we are paid for the quality of decision that we make, not for the next opportunity that's going to give you 10% or 20%. I do my own research. I didn't mention it before, but I'm a researcher for the International Federation of Technical Analysts, and I published 3 research papers in the last 3 years. And the focus has been the first year on money management, and the second and third year on HFT, high frequency trading, and how HFT impacts price structure, as well as in the last a critique of Fibonacci numbers and the way they're used. So of course I use Fibonacci number in a non-conventional way. I'm going to show you some examples later on. Risk and money management, another misconception. I mean, a lot of people do not understand that risk and money management are there to reach trading objectives. A lot of people put up $10,000 in their account and they expect to treat it as an income. So what they want to do, they want to do a 40% in 1 month because they need the 4,000s, right? And I have a funny story. I also lead the Toronto Forex meetup group, so you're all invited to join the group. I see that there are some affectionate people who always come every month. We started this experience in February. We're going to continue. It's been very much satisfying so far. We invited people of the level of Chris Kapp, Navin Pritiani, Alfonso Esparza. There were great traders and fundamental analysts as well. Great experience. So you're all invited. It's the first Thursday of the month, and I hope to see you there. If you want to get the information, I'll give the information after the presentation. So to reconnect to this point, and sorry for being a little bit long and having opened the parentheses here, the focus has to be on doing a small percentage every month consistently. After you get there, you use the tools of risk and money management to magnify that 2, 3, 5%. And you can magnify and multiply it by using other people's money. And basically there are 2 different types of other people's money. There is the money that you extract directly from the market, on which you can risk more, of course. And there is the money that other people trust you with if you have consistent results. So people have to learn how to play the trading game. It's a game. It has some rules. There are some pillars, what I call pillars, which is really the extension of the 3 M's, money, mind, and method to modern markets. And I'm going to show you how different modern markets are. There are also some truths and principles. I think the best book about them is the book from Mark Douglas, Trading in the Zone, and that's something I recommend everybody to read. Everyone who's really serious about trading should actually read the book, study the book, and integrate all the principles and truths of that book into their own trading. Very, very important. And then adherence of market psychology, which I define as the aggregate behavior of the average trader, but actually consider it in aggregate, and I'll tell about this a little bit more later on. In my philosophy, I also want to cater for retail traders. The reason is that a lot of time when traders are successful, what happens is that they start moving into trading for bigger clients. But no one ever caters to the retail traders, and that elite 5% is there, and it's always difficult to reach because people, they simply don't get the right information. So now, I say that modern markets have changed, so let me give you a glimpse on the reality of modern markets. 80% of market volume, up to 80%, is traded by algorithms these days, different classes of algorithms. So maybe there is an opportunity there, and in fact there is. So these are the numbers. Over 80% in the futures market, 20% estimate in options in 2010, 25% in 2006 for Forex, and between 2010 and 2014, if you're interested in Forex, we're talking about 45% and growing. High-frequency trading, it's only one of these classes, so don't be misled. When people tell you about algorithms, there's a lot of focus on high-frequency trading, but there are other algorithms that are there in the market, are very, very powerful, and they move a lot of volume on the daily and weekly time frame, very powerful. And those are the algorithms you have to go with. And this class, I call it program trading. Now, it's never one specific algorithm. It's a family of algorithms working together. But the difference is that these algorithms that I generally call as program trading, they can move between 20 to 30% of the overall volume, and they work on the bigger time frames. So if you need evidence, the sources are here. And then I have the question, so are we sure you want to keep using only the traditional technical tools when you know that that's the structure of the market? So before I say that, I would only consider aspects that are grounded in the way the market works and things that can be proven. So many things, there are only few things that can be proven about the markets. One of these is the existence of trend, of course, and I'm not going to explain what a trend is, of course, because I suppose you know that, but just to make an example there for those who don't, an uptrend is a sequence where price prints higher highs and higher lows, right? Now, the lows in a move higher, of course, are an opportunity for a low-risk trade, and that's what we want to do as traders. So this aspect can be proven formally, but our granddad Dow Jones discovered this in the 90s, I mean actually before, 1993, 96 probably. But what is very important is the existence of algorithms and high-frequency trading and how they actually influence the setups and actually define trends. This might seem a bold statement, but that's the reality of the facts. And I'm going to show you an example here, and also how actually when you start looking at the markets, looking at what algorithms are doing, you also realize that the self-fulfilling prophecies and the levels that generally you would believe actually have an influence, a lasting influence on price, actually is not really there. So let me show you this example here. This is a 4-hour chart of the euro dollar. I will have other examples. So just to prove and show you one thing. When I trace a Fibonacci between A and B, I get an area of potential support in C, and then the price gets into D and E, which are two targets. In these specific examples, the market goes higher into X. Now, I can model this price in a very simple way by tracing from B to X, and I get another area of potential support F. And as you can see, that area now might not be very clear on this chart, but I'll show other charts as well, offers support, and we see large participation from F to G. And that's Why we get that participation is because there is an area of potential participation from algorithms there. Now, the fact that is interesting now is that move is capable of bringing price into G, but not into Y, which would be the second target. And once the market goes and retraces, look at what happens on Y. It bounces on top of the 20-day moving average. And a lot of people would bet that that's a place where there is actual participation in the market. And there is participation in the market. But look at what happens, though. Is there a lasting participation? I mean, this is just an example. I can show you hundreds of examples like this, and you can show me the chart, and I can tell you where this thing happens. Only when the market gets back into H, which is the area where there is the following measured move and where participation from program trading is expected, the market is capable of boosting higher. So that's what I mean when I talk about presence of program trading and class of algorithms in the market. So this is just an example. If you want to look at a more recent example, I give you the euro versus Canadian dollar, which is a daily chart. Same situation. A to B gives us a C, which is an area of entry. And notice how those areas are very difficult to trade on the short side. A lot of people that will get excited that a new trend has started in the euro versus Canadian dollar. So can you see how a change of the approach is very important, and there are ways to time that C as well with a technique that I call flip stalking, and it's actually looking at what happens in what program trading is doing in the smaller time frames. Because I'm going to show you in a minute, program trading is active on all time frames of high volume market. I'm not saying here that you will find this in all the markets. Program trading and algorithms, they need high volume. So that's where you are going to find this kind of pattern. So in this example, the market goes into D and E, the two targets, and then, again, I'm using a very simple pattern. That's not the only one I use. But if you trace from the lows in B to the lows in F, look at where it retraces the market. Now, is that random? Is that casual? What is that? So I can tell you that these patterns work again and again and again, and the reason why they work is because they capture a fundamental way some of the market work. Okay? So only when eventually the setup is not respected in X, that market will start retracing. So there's an assumption here, and you might accept it or not, and even if you don't accept it, if you accept the fact that you can model the market like this, even if you give a different justification rather than say, it's algorithms, you may say, well, that's a method that captured the average market psychology or trader psychology. You give the explanation. Usually I don't ask why. But I see this pattern working again and again and again. So do you have any questions so far? Because I don't want to be the only one speaking and you sleeping if you're not interested. Yeah, those targets are quite standard. It's a minus 23.6% first target, which means 23.6% of the move below A and B, of the move between A and B below B. And the second one will be a 61.8%. So you can look at those numbers if you trade and see how consistent they are. Is there another question? Sorry. Yeah, you can call them Fib extensions. I only use 4 levels in Fibonacci. Yes, as I'll show you, in high volume market, these patterns present in all time frames. And actually, if you trade Forex futures, you can go down to, or SP500 E-mini, you can go down to the tick chart, which is quite nice, I would say. Okay, so before I mentioned the fact of doing things differently. Now, we don't do things differently just to differentiate ourselves. We do things differently because we need that. Otherwise, we end up being in the 95% of people consistently losing money. And, I lost money in the past, and that's why I had to come with something different. Of course, I didn't come with this. I had great mentors on which I built my method as well. So, and as I mentioned before, that for me was my epiphany actually. My change came from that. So I'm a little bit fanatic about doing things differently, and explain you the reason. Of course, we need a different mental framework as well. As I mentioned before, we play to win the game. So what are the rules of the game? We should ask first. The rules of the game is not to think about absolute dollars, but to think about small percentages, monthly percentages, because we know that we have the tools that we can use then to actually magnify those returns. And if you do a 5% every month, that's a healthy 60% per year. You're a superstar in the investing business, and people simply don't realize that, because people think of trading like an income generation type of activity. No, trading is a business. It's not a passion. It can be a passion the first 3 months. Then if you're serious about it, you have to decide, and it's not a game, it's a business. So playing defense is very, very important. I risk up to 1% of my capital when I trade, and actually trading small not only allows you to avoid losing, but allows you to keep your winners as well. Very, very important. There are some rules. Protect your capital. Try to get free risk trades as soon as possible. A free risk trade is a trade that whereas price moves quickly in the direction of your trade and allows you to exit half of the position when you have 1 unit of gain, 1 unit of risk, the equivalent of 1 unit of risk in gains. And that's the way to go, because if you accept the principles of the market, that the market can do anything, there's no other way to go but to take partial profits very quickly and let the trade go. Now, a lot of people, they say, oh no, I don't want to take half off, because then, if the trade works very, very well, I cut enough my gains. Who cares? Because your objective is to do 3% a month, 5% a month. And then you will have the tools to leverage that. So show me you can do 5% every month, 3% every month, and I'll show you can do 30% every month, just by using techniques like money management and risk management. And if you believe that 30% is a lot, well, I worked with my mentor in 2012. He did 400% in 1 year in my face. And he was, I was always using the method, but the potential is huge. So when you start playing by the rules, you remove a lot of pressure as well, because now you know that your objective is different. It's not to generate an absolute dollars from your account, but it's to trade consistently, to make a consistent gain, monthly gain. And a lot of people come to me and say, give me the method, give me the information, right? And they never mind the process that's behind it and the execution. That's very important too. I mean, if you do not execute the process consistently again and again and again, you take your profit out of the free risk trade, you take profits at the profits level, you understand what's price structure and what the market can give you, and so you don't follow the process, you will not do anything with your method, even if it's the best method in the world. Another thing that I always recommend is to do some self-predictive programming. Our mind, our brain was designed to receive and execute orders. So why don't we take the opportunity to give ourselves some orders and actually pre-program ourselves to adopt some behavior that functions very, very well in the market. And of course, now I refuse traditional techie analysis. In my charts, you will never see an indicator or anything that resembles a trend line. I don't use this kind of stuff, and it's not useful, I believe. At least it's not useful for me. I mean, I deeply respect people who can make money with technical analysis, because I know that their success comes from discipline and risk management and money management, and cannot come from a method that in average gives a reliability which is 50%, okay, random. So cannot come from that. Success comes from psychology, comes from proper risk and money management. Psychology, of course, is king. I made a distinction between market psychology, which, as I said before, is the aggregate behavior of the average traders taken as a group, And then there is the trader psychology as well. And it's a very important chapter. We can talk hours about that. I've done a lot of work on my psychology as a trader. And of course, we want to leverage presence of algorithms in modern markets. Now, there is one characteristic that I have in the method I use that tries to identify what program trading is doing on the market, which is price discovery. And that's quite unique because price discovery is about trying to forecast or identify a scenario which has a higher probability when certain specific levels are broken on the upside or on the downside. And I think that's a pretty unique characteristic. I didn't see a lot of trading methods that have this feature here. So now, as I showed you before, and before I continue, I don't want to be the only one talking here, so if you have any questions, please let me know. Yeah. Yeah, that's a very good question, actually, because in the end, Fibonacci is also traditional technical analysis. Well, I mean, all those indicators that come from the 70s, so stochastic and you name it, all the indicators that lag the market. I would include also Gann lines, trend lines, pinch forks, anything that you overimpose on price, basically. Of course, Fibonacci is part of traditional technical analysis, but the difference is how you use it, right? So I use Fibonacci to frame price structure. I don't use Fibonacci just to, if you look at it, the sequences here, they try to identify a structure in price. Well, price action though relies on formation or formation like the pin bar. Now, if you trade the pin bar, you will never be able, I can tell you will never test it. You will never be able to generate a freeze trade. It's too late. The pin bar, it's, well, I mean, now the chart is too small, but the pin bar is exactly what happens in one of these areas of resistance in this case, or support if you consider. So you want to trade closest as much as possible to 50% level, not wait that you can identify the pin bar actually. Anyway, I'm not going into details in this example, but this is just another example that shows that those formation, and this is the pound versus US dollar, are on all representing all time frames. Okay, that's a 15 minutes chart. And as before, when we get the violation of the sequence of measure moving one direction, the market actually changes direction. And we saw this recently for the major currencies trading against the US dollar. And actually, if you go on fstreet.com, I have mentioned on October the 1st that when I saw all these measured moves failing on the daily time frame, that we would actually get a relief rally in most pairs. In fact, we saw that basically in the majority of the pairs trading against the US dollar. For example, the euro dollar, New Zealand dollar versus US dollar, Australian dollar. Probably the pound versus US dollar is the one lagging at the moment. So, well, I'm not going to spend a lot of time on this because I don't want to go to. I don't want to go to over time. What I want to show on the other side. No, I don't, because I believe there is only one pattern where the participation of a class of opportunity to follow is expected. So my answer is no. In the past, I did. With that gentleman I mentioned before, Ivica Juracic, who's a European-based stock trader, very successful one. He trades using a lot of consolidation patterns. So he trades really the A, B, consolidation, C. The point is, I made a study on that as well, and it was published in 2012. And I showed that there is a better way of picking stops using, again, this kind of retracement. So that convinced me that, there was another, even a better way to go. And that's the reason why.
Yeah, so you focus on the
only on this pattern.
And you ignore everything else, and you do your research based on this method?
Yeah, only that, yeah.
Because I was going to say, even patterns don't also break one.
Yeah, the point is that.
A lot of research on one particular pattern here, a small number, and you have to ignore the rest because there are so many, and sometimes they can overlap with each other, and sometimes they can give you mixed signals when they buy, and sometimes they store.
Yeah, I mean, I agree with your statement that you should only use one if you do, because when you start, as I mentioned before, I don't like mixing multiple signals, because then you start getting those inconsistencies and you have to resolve them. So you have to have rules to resolve them. And every time you add the rules, you are reducing the degree of freedom of your overall system in explaining price, in explaining also future price. Because when you add rules, you are fitting your system on the data set that you have. So there's no guarantee that's going to work on the price data you'll get in the future. So very, very important point. Let me show you how I go. When you see these levels here, I never buy blindly or sell blindly at the blue line, which is the 50%. I use another technique, and as I mentioned before, and I showed you also, program trading and algorithms are active on all time frames, so we can use the sequences of liquidity on price on the smaller time frame in order to decide whether the participation coming at that C area is strong enough to break the sequence, the counter trend sequence. So let me explain you what I mean here. I have an ABC with an area of support there, and it was tested 3 times. The third time, we are going to analyze the third time. So let me focus on that area that I've highlighted there. So this is the 4-hour chart. And again, when we drill into it, we see the same patterns again and again and again and again. So there's a fundamental idea here. If there is a pattern now and a sequence that actually drives this price lower in this counter trend move into that area, bigger area of potential support, let's study that sequence and let's see whether it breaks in correspondence of that area of support in C. If that happens, that's an indication maybe that the participation in C is strong enough for us to trade it and to try to bring price into the target. Now look at where the target is. It's D, and I'm not cherry picking here. If you look at these patterns, they're there all the time, everywhere. Look at the reaction that you had at the first target, which is minus 23.6%, which is 23.6% of the distance between A and B above B. So look at what happened there. It happened twice. Why that happens? So you explained me. It happens because there are algorithms that are taking profits there. And again, that level was not cherry-picked. You can go back and look at these simple patterns on price, and you recognize them again and again and again. So the main idea of the feed stalking technique, which is the technique that they use for timing the market, is actually studying the counter trend sequence into that area of support. And if that breaks, like it happened above G there in X, then that's an indication that there is participation from the larger area of support, and now it's safe to get along there, even on a breakout of that level, with a stop below lows. And you might think that in this case you were lucky, but you will find thousands of these kind of moves in the market. Okay. Now it's a new concept, so I understand that it might not look familiar or something that is actually happening in the market. Also because we suggest that that there is some way of some sort of control or there are algorithms that actually bring about the price structure. But that's the reality. I mean, if you go around, you can see these patterns again and again. And what is interesting here is that by applying this technique, you can actually derive now a procedural way to test area of support and resistance, which is something unheard in trading. Tell me which methodology, traditional technical analysis-based methodology, as a way for you to do price discovery as well as time the area of potential participation in current trading. So I think that's quite interesting. So before I get into that, do you have any questions about this? Sure.
So on this particular slide, A to B,
Yep.
and then going through C.
Yeah, the area where I expect participation from algorithms.
That's the 50%.
That's the 50%, yeah.
And then
When we draw, yeah.
two targets there, the second target would be a B.
No, that's the first target. The second target is even higher.
I'm assuming that you're not going to make an assumption when you move on to the second target.
Oh yes, he can, of course. In this case, he didn't. In this case, he went back. And by the way, in this specific case, look at the chart. It's not shown here, but you can see this at home or on fxtrade.com. In this case, he went to G and retraced it to the 50% of the distance between C and D. And again, there was participation at that level. Okay, so there is some order in these markets that can be modeled. Does that answer your question?
Yeah, that's perfect. I just showed the second perspective.
Very good. So, yeah, so that's the main idea of it. Now, once, yeah.
When we are using the Fibonacci, do you use it
I use on all time frames, but only in markets that have high volume. So all the Forex markets, the SP 500 the mini futures, the gold mini futures. You can use that. It works quite well on bonds as well, futures, bond futures. And you can use on high volume stocks. So these are all markets where algorithmic trading is present. Okay? Well, I mean, if you apply this to also less traded currency, you still see those patterns. But I always suggest to use this on the majors. Particularly, I follow 12 markets, and that includes all the majors plus the Japanese yen majors, Euro, USD, and Pound, and it works quite well. And by the way, I mean, if you're interested, you can go on my blog. I have over 600 videos you can access for free. And I do this analysis twice a week and share it with my newsletter subscribers. So just subscribe to the newsletter and you'll get a glimpse of how systematic the approach is and how frequent and how easy it is to, now that you have the fib stalking technique, how easy it is to trade those specific spots that psychologically are very difficult to trade, because when the market is actually moving into F and you don't understand price structure, what you expect is even lower prices. And I actually get emails from people sometimes. I mean, I got this position, the market is going lower on me. Please help. Where I should help? What is the next measured move? And the point is that look at how the market reacted at G. It's not a case it reacted there. It reacted there because there was program trading waiting for that. Now, that was not enough because the participation that came from the larger area on the daily time frame was strong enough to break the sequence. But sometimes that doesn't happen, and now you have a procedural way to decide that. Unique. I mean, it's quite powerful, I believe, and it works for me. So, now, with these tools, now my trading process is totally changed, totally different, and it's also much simplified. So what I do, I select a market. Actually, I don't select the market because the market selects itself. Because now what I do, I just trace these patterns on all the markets that I follow. I mean, I follow 12 markets, including the dollar index futures. And then it's the market itself that is telling me where I have to get involved, right? I mean, the market is telling me if I trace from A to B at the beginning of October, I might have, in this specific case, this specific time frame, 2 months before the market gets into my level of interest. Of course, in the meantime, I'm trading on other time frames, or I'm trading other pairs. But you can see that you know well in advance. In this specific case, you have well in advance the level, the area there. So we don't have a lot of time. We only have 5 minutes to go. So I just want to quickly present the high-level steps of the trading process. So I select the markets I'm interested into, and I come up with a trading plan on the specific time frame. For example, that daily time frame. And of course, there might not be any setup in that time frame. In that case, if you trade on the 4 hours or on the 15 minutes, you can find other setup on those time frames. I study the algorithm's activities also on the larger and smaller time frame because I want to get the full picture. As I told you, algorithms are present in all time frames, so if I get the whole picture, I can use all the information in price discovery to validate my trading plan or not, to know whether my trade can go to target or not. So I gather all this information, and then with the point at having 1 and 2, I validate my trading plan, and I decide how to get a free-list trade. This is an essential point in my trading methodology. When we get those kind of opportunities and we time them, more often than not, when the participation on the larger time frame overcomes the participation on the shorter time frames, that participation is also strong enough to give you a free-list trade, which means to bring price at a level where you can take half of it and basically reduce your risk to zero. Well, you reduce your risk to the cost of doing business, so the cost of transactions and slippage, which is a great thing. I wish a lot of traders would do that. So I then use the flip sorting technique that I showed you before to time the entry. And I do also additional consideration of risk and money management, because risk and money management are our tools to reach our trading objectives. And finally, nothing new here. We execute, we monitor in a mechanical way. The good news is that if you have a strong enough move that gives you a free-list trade, now you can actually take that trade out of your mind and start looking at other time frames and looking at other forex pair, because now you don't have to worry about that anymore. Whether it goes to your profit or stops you out, you don't care. I mean, it's not, you did your job. You through your process, you did your job. And the nice thing is that now you can start trading against yourself in the different time frames in the same pair. And that's something very, very interesting that you can do. And you have freedom of mind so that you can say, okay, I have on the smaller time frame, I have a short now, I'm a long. On the daily, I have a short here with a profit. And you look at price structure and you see whether you can, it's a meaningful trade. And you go with it. And you just relax. And of course you monitor the position on yourself. And you work on your mental model to become disciplined about this process. So that's basically it. I think we have a Q&A before. We'll still have some time for some questions before they stop us. Yeah. I provide, at the moment I provide a coaching program on this. And I actually review the markets multiple times every week together with my students, and we apply the actual concept to the current markets. That's what I do at the moment. Pardon me, again? Yeah, I mean, you can contact me. I have an ongoing, it's a 2-month program. I have an ongoing, I think I have a slide here. I have an ongoing program with 10 participants at the moment. And actually, one of the participants is here as well today. And so you can ask an unbiased, if you wish, consideration. And I have another class starting in December. It's almost full already. So there's a lot of interest. I have to move some people in December because I keep the classes small. And there is a... I personally I don't, because I don't use a forex specific platform. So typically I don't recommend. At the moment I don't. I might in the future, but unfortunately I cannot help that. I mean, you know, it wouldn't be fair if I told you something that I don't choose. So I don't, but that's not my model, though. I don't, for example, I don't work with rebates, and that's not my model. I mean, my idea is to kind of empower retail traders and people to learn how to trade. So that is it. Thanks a lot for your participation, and if you want, I have some. Thank you. Thank you very much.